What is up, world? It's your boy Tanh, and you are listening to the Wonton Wealth Podcast. Here, I'm going to unravel anything and everything commercial real estate related. And more importantly, we're going to add abundant value. So if you're ready, buckle up your eardrums. Today, we're going to dive into three terms that every savvy investor needs to know. These are the loan to value ratio, the debt service coverage ratio, and amortization. So stick around, and by the end of this episode, you're going to be throwing around these terms like a pro. First up, we're going to start with the loan to value ratio, or LTV for short. So picture this. You set your sights on a magnificent property and it's worth, let's say, $1 million. But your money isn't there yet. So you're going to look for a lender to finance your project. And they are going to look at the loan to value ratio. The loan to value ratio, or the LTV, is a trusty compass that's going to let the lenders determine how much they can safely lend to you. And it's a simple math problem. You got the loan amount and you got the property value. So you're going to take the loan amount and you're going to divide it by the property's value. So here's an example. Imagine the same property that you have at $1 million. And imagine the bank is willing to give you a loan for $900,000 for that $1 million property. And so what is the loan to value ratio? You take the $900,000 that the bank is willing to loan you and you divide it by the $1 million property, and that's going to give you 90%. So the LTV is 90%. The higher the LTV, the riskier the loan is for the lender because they're loaning out more money on the property. And typically, the higher the LTV ratio, the higher your interest rates are going to be for that project, or they're going to have more stringent requirements for you in order to secure the loan. So next up, we have the debt service coverage ratio, or DSCR. And this metric is pretty much a litmus test for the property's financial capabilities. It's essentially a gauge of its ability to generate enough income in order to meet the mortgage obligations. So you're going to be looking at essentially two numbers. When you're looking at your property, you're going to see the net operating income, or the NOI. That's going to tell you the net income from operating activities. And now, if you already know your yearly mortgage debt service, you'll be able to figure out what the debt service coverage ratio is. So let's go into an example. So let's say that $1 million property that you had. Your NOI for the property is, let's call it $140,000. And the debt service for that property is $100,000 every year. So now you take the NOI and you divide it by the annual mortgage debt service of $100,000, which is $140,000 divided by $100,000. So that gives you a debt service coverage ratio of 1.4. A debt service coverage ratio over 1 means that the property generates enough income in order to cover its debts. Banks are generally looking for anything over 1.25. And conversely, if the DSCR is less than 1, that means the property can't even manage to pay off its mortgage, which means it's a higher risk profile, and lenders are typically not going to lend on that. Once again, your lenders or borrowers typically like to see a DSCR of 1.25 or higher. The higher, the better. And thirdly, we're going to go over amortization. So amortization is pretty much the art of divvying up your loan into a series of fixed payments over time. It's like slicing through a huge sandwich bit by bit until every piece is devoured. So this process is going to help you take down the loan in bite-sized chunks. It helps you pay off both the loan principal and the interest over the life of the loan. Technically, amortization is an accounting technique, and they use it to periodically lower the book value of a loan or an intangible asset over a set period of time. And with amortizations, you're going to have an amortization schedule. And this is essentially a detailed menu that unveils the inner workings of the repayment journey. It's going to highlight what your outstanding balance is, what your monthly payments are, and with those monthly payments, it's going to break down how much of that payment is going to the principal of the loan and how much of that payment is going to be the interest on the loan. And over the lifetime of your loan, you're going to see that the outstanding balance is going to gradually dwindle down. And in the beginning of the loan, you're going to have higher interest payments. Whereas as the loan matures later down the lifetime of the loan, your principal payments are going to increase, whereas your interest payments are going to decrease. Hence, you're going to be paying off more of the outstanding balance later in the loan, which is why the longer you have in a term, the more interest you will be paying to the bank for that loan. But for that longer payment, you're going to have lower individual monthly payments. And there you have it. Those are 3 terms that you need to know in order to talk to your banks and be a savvy investor. Understanding these terms can make a world of difference in your real estate ventures. So next time you're chatting with your lenders or fellow investors, you'll now have the confidence and knowledge to navigate the conversations like a true expert. And that's a wrap. If you've made it this far, that means you've listened to the entire episode, so thank you. I hope you enjoyed it, and if you did, please leave a review on Spotify, Apple Podcasts, or wherever you're listening from. And if you've learned something or found it useful, share it with one of your homies. And if you want to get in touch with me, I'm pretty active on IG. My handle is pro_TANH. Reach out, let me know what you liked, what you didn't like, or what you want to hear about in the future. I'm here to tailor this to you. Until next time.